Good morning folks, this is Naeem Aslam, Chief Market Analyst at AvaTrade. Welcome to our daily fundamental video analysis. Let's begin by looking at the equity markets, and I am speaking of US equity market. We've seen that massive plunge once again for the US equity market. All the three major indices, as you can see in the chart, the Dow Jones, the S&P 500 and the Nasdaq all closed pretty lower yesterday. They dropped well over 2%. In fact, the drop, as again shown in the chart, was well over 400 points for the Dow Jones Index. Now, the question is why we've seen that massive sell-off. The sell-off was pretty much led by two major factors. A, it was a massive sell-off in the energy sector. Why? Because the crude oil prices dropped below that critical level of 20, and we'll talk about that a bit more a little bit later on. But the other thing which really drove the markets lower yesterday was the earnings seasons. What was that in that earnings season? I think investors were very scared because of those numbers that these banks were producing with respect to two different elements. First, the provision of losses, that the money that they are allocating for the bad debt that is enormously high. But overall, I think we're looking in around over 4 billion. Now, if you compare that number with that 2008 number, it is still half. But the headline when it came to all these news channels that, okay, you know, the banks have put more than 4 billion just in terms of for those debts. And then I'm talking about the three major banks. I'm talking about the Bank of America, JP Morgan and and Goldman Sachs. It just really took the overall sentiment in the market, because the number is still 4 billion, which is 4 billion less than what we have seen back in 2008. And secondly, it is like someone was expecting that, okay, these numbers are not going to be that bad. Of course the numbers were going to be bad. Of course this earnings season isn't really going to be that rosy. We are expecting these numbers to fall substantially, and in fact the numbers going to be bad for the next quarter as well. So it's not only the Q2, in fact the Q3 is the quarter where we are going to see major impact of coronavirus. But what we are going to see in Q3, the difference between Q2 and Q3 is that the outlook is very uncertain in Q2 and the outlook will be less uncertain in Q3. That is the difference, and I think that is what is going to shift the sentiment or narrative. But when we look at the overall equity markets, yes, we've seen this massive rally. Yes, we've seen the S&P 500 going above the 50-week moving average, and now it is challenging the 50-day moving average on a daily time frame. But I think the momentum is very much lagging now. And I think as the earnings seasons will continue to feed more negative news into the market, I think it is highly likely that the market will pull back again, because investors are going to react to this. But the only thing which can really fade away all of this particular element is the optimism that how the economy is going to go back to normal. The lockdown measures are going to be eased off. Remember, Germany also came out yesterday with his plan, and Donald Trump later on today is also going to announce about the lockdown measures and how he is going to ease those measures as well. So this element combined with this narrative of negative pessimism about earnings, they're going to continue to battle with each other. And I think that there is still room for another leg lower for the equity market, or at least for us to see that double bottom forming. Remember the March 23rd low. If the market comes back to this one, that would be great. But why I am saying is because if we look at the recent sell-off, the major plunge that we've seen during the 2007 or 2008, we saw the market falling below the previous lows. And I think it is possible just because oil prices are still trading very, very low. Now, speaking of oil prices, the crude prices, as you can see in the chart, still trading well below that critical level of $20. And the support is still sitting between that $16 to $19, or let's say that $16.50 to $20 mark. And this is the area where we are very low on the curve, and perhaps traders should only be looking for long positions, not short positions, because the room for in terms of a risk to reward ratio isn't that great at all. But remember, you can always protect your upside and your downside positions by using AvaProtect. That's all for today. See you guys tomorrow.